What's ahead for the world's stock markets? This was a lost decade for the American stock market. It went nowhere at all. But for much of the developing world, it was the roaring double O's, a period of soaring markets and breakneck investment that left even some bulls wondering if the good times can last. While the broad American market lost about a fifth of its value in the last 10 years, emerging markets like Brazil, Russia, China, and India powered ahead with gains in the double or even triple digits. The numbers are staggering. On Ukraine's PFTS stock exchange, a wild east of investing that did not even exist until 1997, shares soared more than 1,350% over the last decade. In Peru, stocks jumped more than 660%. And in India, the Sensex index leaped more than 240%. To believers, those heady gains underscore profound shifts taking place in the global economy, where investment dollars, euros, and yen whiz across borders and time zones with the stroke of a computer key. So as many Americans wait for an economic recovery, money is pouring into the fast-growing economies of Asia and Latin America, as well as into oil-rich Russia and the former Soviet bloc. What we're living through now is something of epic proportions, said Alan Conway, the head of emerging markets equities at Schroders, the big money management company in London. He likened the economic rise of nations like Brazil, Russia, China, and India, the so-called BRIC countries, to that of post-war Japan. Amid all this euphoria, even some long-time bulls wonder if investors are getting a bit carried away. Emerging markets have a history of giddy booms and crushing busts dating back to the 19th century. They collapsed spectacularly in 1997 as a chain reaction of currency devaluations, bankruptcies, and recessions rocked East Asia. In 1998, the Russian market plunged more than 80% after the country defaulted on its debts. And more recently, emerging markets tanked with the rest of the world in 2008 after shell-shocked money managers took cash from anywhere that seemed risky. But they were a bright spot in 2009. The MSCI Emerging Markets Index increased 73% in 2009, compared with a 25% jump in the S&P 500 index. But despite 2009's gains, few predict a major setback today, but it's hard to see exactly. Since the 1998 debacle, some developing countries have cleaned up their acts, balancing their budgets and improving their trade balances. As their economies grow, domestic investors have become big supporters of these countries' stock markets, and with interest rates low around the world, companies based in emerging markets, like their counterparts in the developed world, enjoy access to cheap money. High commodities prices, at least for now, have pushed up stock and bond markets in nations but are big exporters of commodities. But the recent troubles of Dubai, where a debt-driven bubble economy is now bursting, provides a powerful reminder that in up-and-coming economies, what goes up can come down, and fast. That these markets have gained so much so quickly, with some white-knuckled drops along the way, gives some investment professionals pause, because there's something much more going on here, something much bigger. Mark Mobius, one of the deans of emerging market investing, said that while developing markets still have room to run, the first half of 2010 could be bumpy. We continue to see upside, but with substantial corrections along the way, which could be as much as 20%, said Mr. Mobius, the executive chairman of Franklin Templeton Investments, which is based in San Mateo, California. Some market experts worry that asset bubbles akin to the one that inflated and burst in the American housing market might possibly be growing in places like China and Hong Kong. Others worry over the risk posed by volatile commodities prices, as well as over the inevitable end of this period of ultra-low interest rates. And as long-term investments go, emerging markets seem to have a lot going for them. On average, developing countries have less sovereign, corporate, and household debt than developed countries. For now, at least, their economies are also growing faster than industrialized ones. Merrill Lynch predicts that emerging market economies will grow perhaps 6.3% next year, if all goes well, while the global economy expands by 4.4%. Again, if all goes well. Emerging markets are eclipsing their developed peers in other ways as well. Imports to the BRIC nations are likely to surpass imports to the United States for the first time ever in 2009, according to Morgan Stanley. So, for the moment, the developing world is the engine of global growth. Emerging markets accounted for virtually all of the year's growth in global output, because developed economies shrank or were flat. Even if developed countries could recover completely in 2010, emerging economies will account for 70 to 75% in the growth in global output for the foreseeable future. Developing nations are also assuming a bigger role in the world economy. Morgan Stanley predicts that developing countries, including those in the Middle East, will account for 36% of total global gross domestic product in 2010, up from 21% in 1999. And of course, all this is a big lure to investors. Funds focused on equities in emerging markets attracted a record $75.4 billion this year, far surpassing the previous high of $54 billion in 2007, according to EPFR Global, which tracks fund flows. And even after that influx, emerging markets still account for only a small fraction of investment portfolios in the United States and Europe, the world's money management centers. Less than 3% of assets managed by United States fund managers are invested in emerging markets. That number could double in the next few years, some investment experts say. Investors are starting to look at this asset class and realize that it is a pretty safe place. Despite their volatile history, emerging markets strike some money managers as relatively secure places to invest. But of course, such hopes have been dashed before. And again, these are times like never seen before. Huge changes are happening. Because these are the transition days. End times transition days. The transition is ongoing, a continuing daily process. And there are many signs.